Hey everyone, my name is Jack, and in this video I wanted to talk about one of Ray Dalio's many hot takes that he has on the economy. If you're not familiar with who Ray Dalio is, he's a billionaire hedge fund manager of Bridgewater Associates, which has about $160 billion in assets under management. He writes frequently and goes on shows all the time to give his well-reasoned insight on the economy, debt, the market, and other trends. His perspective that he shares tends to be super high level, focusing on macroeconomic forces rather than something like individual stock picks like many other hedge fund managers might do. Before getting into his recent Bloomberg interview, if you guys want to see more of this type of content on the markets, stocks, and investing, be sure to hit the like button so I know that you like this sort of content, and then I'll create more of it. And also remember that I am not a financial advisor and I am just some guy on YouTube trying to stay well informed. Please like this video rather than using what I say as some sort of righteous financial advice. Thank you. Anyways, here's what Dalio said in a Bloomberg interview last week.
So this period, like the 1930 to 45 period, is a period in which I think you'd be pretty crazy to own bonds. Okay, because what is a debt? A debt in a fiat currency is a promise to receive currency, and isn't it pretty clear they're going to make a lot of currency? So I think that changes the appeal of bonds. Why in the world would you hold the bonds?
What Dalio's really saying is that cash and cash equivalents are terrible during an inflationary time. Treasury bonds and lower risk bonds are considered cash equivalents in many cases. Typically, when investors refer to cash, they are including cash equivalents like short-term treasury bonds. And before the downturn, Dalio did explain how he thought that cash is trash.
But also the question is, what do you jump into when you jump off the train? And the issue is, you can't jump into cash. Cash is trash, okay? Cash is that they're going to, because they're going to print money. What do? You get out. Okay, so cash is not going to.
So what do you do?
So what you have to do is you have to have a well-diversified portfolio. And first of all, you have to be global, and you have to have balance. Then you have a fiat monetary system, which means that you can print whatever amount of money you want.
And just one more thing about this interview. I'm not really sure where they are, but it was in January of 2020. You can see snow on the trees. They're clearly outside. The anchor next to Ray Dalio has a big old coat on. And yet Ray Dalio's just chilling in his blazer, no coat, no anything, just taking it like a champ. I just thought that was hilarious. Anyways, back to the video. Ray Dalio thinks that cash and cash equivalents are in big trouble right now, partly because of the aggressive quantitative easing that the Fed is doing right now. And with talks of a second stimulus, we'd see an even larger cash injection being pulled from our future pocketbooks being spent for now. This would potentially cause big inflation as well. Inflation corrodes the value of the dollar, and as Dalio also explains,
I believe that when you look at bonds and debt, a bond is a promise to receive currency. So you have, when you're holding a bond, that gives you no interest rate or a negative interest rate, and they're producing a lot of currency, and you're going to receive that. Why would you hold that bond?
So Dalio thinks it's stupid to buy something that only promises to pay you more currency at the end of the term that would end up being worth less than inflation, if not flat out negative to begin with. Now, this does not mean that bonds don't still have a place. They generally are considered a way to preserve capital, at least in the short term. Dalio is arguing that they are not even serving that purpose well right now because of how low interest rates have gotten and because the government is printing more and more money each day. Most bonds are not inflation protected, just like any other fixed interest rate debt. Inflation is a lender's worst enemy on a fixed interest rate loan, which is basically what a bond is. If you lend your money to the government or a corporation at 1% interest, or even less as it is in many cases right now, but inflation ends up being 4% because of massive quantitative easing and printing lots of money and lots of new debt propping up spending, you basically just took a 3% net loss on your money. The money you receive in interest will not make up for the lost value due to inflation. But inflation in the US typically is never super high, though other countries have had a problem with hyperinflation in the past, and even recently. You can look at Zimbabwe or Venezuela for egregious examples. In those countries, money became practically worthless within hours due to inflation. While the US would be unlikely to get to those levels, our current practice of printing lots and lots of money to try and prop up the economy is certainly a bit dangerous. But the alternative is to not use monetary policy and risk having an even worse downturn. So it's really a lose-lose right now. And really at the moment, we might even be seeing some slight deflation, where the value of money is actually increasing despite the absurd amount of money being printed everywhere. However, if the markets go down again, say 10 or 20% in the near future, having cash suddenly looks like a brilliant move. Even with inflation, you're almost making a sort of positive return by avoiding the negative return in stocks. Then you can take your cash and use it to buy the much cheaper stocks to have a strong hedge against inflation after that. And even if cash does not increase in value with inflation, using your cash to buy inflation-protected assets, like many stocks, can be a great strategy for the long run. After all, that's the whole reason we invest in the first place, to make our money worth more than it was in the past. Buying a share of a company will increase in value proportionate to its profit margin and the innovation it creates, mostly regardless of inflation. Holding cash will only move with the value of inflation, which is typically positive, so your money will be consistently worth less over the long run due to inflation. With cash, you have a guaranteed risk of inflation. With stocks, you have a constant risk of the company failing. Pick your poison. Investors like Dalio would almost always pick stocks over cash, since they have always performed better than cash over the long term. And this isn't to say that having cash in the short term is a bad idea, but investing your cash into high quality assets is perhaps the ultimate hedge against inflation. And if you guys want to start investing in some stocks or bonds, if you don't really care about what Ray Dalio says, check out my affiliate links in the description below to get yourself 3 free stocks by signing up for Webull and Robinhood. You can sell these stocks right after getting them and close your accounts. I don't really care. They're free stocks on free brokerages, so get your free money, please. It might only be a few bucks worth of stocks, but I was able to get 20 bucks worth of stocks when I opened my Webull account, so you might as well take advantage of the promotion too. You apparently can get a stock worth up to $1,400 when you open a Webull account and up to $200 with Robinhood. And let me know what stocks you guys get so I know if this promotion is working well. Well, that's all I've got for today. If you like this video, like it, since it helps the channel out a lot. If you want to see more of this type of content on the markets, investing, real estate, and other personal finance topics, be sure to subscribe so you don't miss any new updates. I post new videos every single week and wouldn't want you guys to miss out. What's your investment strategy right now? Let me know in the comments below and we can get a discussion going. But until next time, take care.